So India's central bank has come down very, very hard on Kotak Mahindra Bank.
The Reserve Bank of India has barred Kotak Mahindra Bank from onboarding new customers and issuing new credit cards with immediate effect. This over data security concerns and deficient IT infrastructure.
In its statement on April 24th, the RBI spoke of, and I quote, significant concerns arising out of Reserve Bank's IT examination of Kotak Mahindra Bank for the years 2022 and 2023 and the continued failure on part of the bank to address these concerns in a comprehensive and timely manner. The statement also said that for 2 consecutive years, the bank was assessed to be deficient in its IT risk and information security governance, contrary to requirements under regulatory guidelines. During the subsequent assessments, the bank was found to be significantly non-compliant with the corrective action plans issued by the Reserve Bank for the years 2022 and 23, as the compliances submitted by the bank were found to be either inadequate, incorrect, or not sustained. It said Kotak's digital banking channels have suffered frequent and significant outages in the last 2 years, the recent one being a service disruption on April 15, 2024, resulting in serious customer inconveniences.
If you read in between the lines, it says that everything that had to fail has failed. Their IT infrastructure has failed, their risk management system has failed, their core banking system has failed. It's a very strong statement, and never before we have seen RBI making such a stern remark on any bank.
The move has been a big blow for Kotak. The bank has lost over $1 billion in market value in the last few days. In fact, the losses have been so significant that Kotak Mahindra has ceded 3rd place in banking market cap to its nearest rival Axis Bank. Of course, Kotak is only the latest financial institution to face the RBI's wrath. On January 31st, the RBI barred Paytm Payments Bank from taking fresh deposits and doing credit transactions as it had allegedly not followed rules. In October last year, the central bank barred Bank of Baroda from onboarding customers on its app. In November, it stopped Bajaj Finance from sanctioning and disbursing loans on its 2 loan products. And of course, in 2020, it barred HDFC from sourcing new credit card customers due to frequent outages.
Let me say very clearly, I do not believe regulator is overstepping. Okay. The one word answer is no, they are not overstepping.
In this episode, we analyze the RBI's recent mandate and what it will mean for Kotak. We also try to delve into what's wrong with the banking sector's adoption of tech that irks the country's central bank again and again. Listen on. It's the 30th of April. I'm your host Anirban Chaudhary. This is the Morning Brief. First up, I spoke to Sangeeta Mehta, my colleague and ET's banking and corporate finance ace. I asked her if she was surprised at RBI's action.
Yeah, it's totally out of the blue. It was like a big surprise to all of us. See, there have been outages and there have been reports of cyber frauds in the past, and not just about Kotak, about a whole lot of banks we've been hearing. But this is quite unexpected. But if you look at RBI's statement, which came out on Wednesday just after the market closed, it kind of sent across a message that we've given them a very long rope and enough is enough. Now, after 2 years of consistently following up with them, asking them to upgrade their IT infrastructure, it hasn't worked. And they have also stated in the statement that it continues dialogues with the management, and probably they were hoping that things would get better in coming quarters. And it seems to be that has not happened, because they said that the response from the management was far from satisfactory, which means that at some point of time, they probably gave up and then they decided to take action. So they have also suggested that the trigger seems to be the disruption which happened on April 15th of this month. And the statement, if you read in between the lines, it says that everything that had to fail has failed. Their IT infrastructure has failed, their risk management system has failed, their core banking system has failed. It's a very strong statement, and never before we have seen RBI making such a stern remark on any bank.
And this hits really hard because in the last few years, Kotak has heavily invested money and effort in bolstering its digital banking footprint, primarily under the behemoth scion Jai Kotak.
Significant portion of their customer acquisition is about onboarding them online through mobile app. In fact, their annual report shows that 72% of new customers that were onboarded in FY23, which is the latest annual report and data available in public, 72% was onboarded through this app.
Right.
Which means that this app was playing a very significant role. And the fact that product was spearheaded by Jai Kotak, son of Uday Kotak, means that the bank had given a lot of importance. In fact, their product Kotak 811 is one of their flagship product where they onboard customers where you do not have to step into the bank, and everything end-to-end onboarding is done online. And the advantage for the customer is he doesn't have to maintain a minimum balance, which most of the private banks insist on maintaining in the region of 10,000 to 15,000. And you continue to get all the facilities that a private bank offers. They saw this as a way to attract new customers, and it worked very well.
Also, this is coterminous with their going slow on their offline expansion also, right? Like you
Yes.
wrote in the story.
So just to put it in perspective, Kotak has added just about 350 branches in 4 years, as per Macquarie report. And HDFC Bank, they have added about 900 branches in 1 year. That clearly shows that they've been using this model 811 to onboard customers, and the deposit mobilized through their branches per branch for Kotak was the highest among the top 5 banks. If you leave aside HDFC, because HDFC has that merger effect, but it did save them a lot of cost. Here the problem is probably what the regulators or the question that would have occurred to them is that when you're scaling up so fast your online or onboarding customers through the mobile app, probably the IT infrastructure did not keep pace with that kind of increase in volumes, which happens when you onboard new customers.
Okay, now let's talk about impact. For one, the company has lost more than $1 billion in the market in just one day. I think the losses will be even higher today. But other than that, also their deposits is going to see a slowdown. What do you think will be the impact in the next 2-3 months until this ban is still in place?
See, very clearly what deposit is to a bank is like what is a raw material to a manufacturer. No,
Correct.
Without deposit, a bank cannot just grow. See, it's very clear that their growth will moderate. Whatever is targeted, in the sense that they have seen a deposit growth of 18% and credit growth of 16%. Now, this could marginally fall because the whole focus
This is in 1 year?
Yes, this is in the December quarter. Clearly, what it means is that their focus is going to shift to fixing the IT infrastructure, which is going to be their priority. And you will not have new depositors coming through online, which means only walk-in customers. And the walk-in customers will not be given a credit card. So how many walk-in customers, at least in the cities, would actually want to open a bank account where they do not have access to a credit card? Because see, the new customers are the young kids who either going to college or have just started working. Secondly,
And clearly, the urban affluent customer would be the largest chunk of Kotak's customer base, right?
yes, all private banks, it is the affluent class which they're targeting, because they are the ones who are going to keep money in their savings account. They
So it's a
have
big blow.
it is a big blow, but see, Kotak has a lot of services to offer. They provide car loans, they provide securities business. So there are a lot of other businesses which will do. So the group as a whole will do well, but this particular development will shift their focus from everything else to fixing this first. Because also remember, this is reputation risk for them. It's not just a restriction on raising deposits, because they can raise bonds, they can raise money through CDs. It's just that they cannot take new retail customers. The existing customers can still go and deposit money with them, they can still have an FD with them. So the new customers will not come. It might just take 6 months, it might take 9 months for this, because very first thing that they're going to do is now they are going to appoint an external auditor who will come up with a report on what went wrong. And then that external report will go to RBI, and RBI itself has its own inspection report, which they had conducted, following which they took this action. Kotak will have to satisfy, or kind of will have to fix those things, and then the approval will come to restart the business.
But Kotak is unlikely to be the last bank in the line of RBI's fire. And like I recounted in the beginning of this episode, it certainly isn't the first. The RBI has given 3 warnings to bank already this year to buck up on IT upgradation and governance. It has told banks that they are spending too little on IT infrastructure. It has asked them to undertake drills and system checks every 6 months. Not much has happened, clearly. The other bigger criticism, of course, is that many of these banks are onboarding customers at a pace which is way beyond what their current systems can regulate. Now, the solutions to many of these problems can be found in the past. In a seminal RBI report filed way back in January 2011 and mandated in April that year. It was filed by a working group on information security, electronic banking, technology risk management, and cyber frauds. The report pointed to many of the problems that are very relevant to banking tech systems today, from inadequate senior management and board awareness on IT use and governance to the fact that organizational structure of IT is most often not in line with business needs. The RBI mandated banks to follow the guidelines. It's been 14 years and many still don't. So I reached out to the author of this report himself, the man who headed that working committee, G. Gopalakrishna, former executive director at RBI, who gave 37 years of his career to the central bank.
The background of constituting this report by the Reserve Bank of India was that most of the banks had started implementing core banking system by 2010. Almost all the banks had core banking system. Many of the banks had mobile banking, internet banking, ATM, and so on and so forth. But at the same time, RBI had observed that there are a lot of issues relating to downtime of core banking system. Large number of frauds have started happening, especially those days we used to call it as 419 Nigerian frauds in a big number.
Right.
And a lot of complaints used to be there. And this was the background under which RBI constituted a committee known as Working Group on Information Security, Risk Management, and Cyber Fraud. The scope of the committee was very, very comprehensive. It covered corporate governance relating to information technology. The other areas included information security, and information security included data security. So almost 60% of the report is on information security and data security. The other recommendations or guidelines implemented by the Reserve Bank related to IT operations, IT outsourcing, IS audit, cyber fraud, and most importantly, the business continuity planning, what is known as BCP. And as you rightly said, it was much ahead of its time because it was a very comprehensive guidelines on information security and IT operations, IT governance.
Right. So also, I mean, the problems that you just mentioned, which is the genesis of the report actually goes far beyond those problems to in its recommendations. It is so relevant even today. Were there international frameworks that inspired some parts of this report?
I think it's a very good question. See, not that RBI did not had guidelines on IT operations and all. I see IS audit. There were few guidelines prior to 2011 before this committee's report was implemented, but they were all very, very brief and not very comprehensive. And it was therefore decided that this committee will consolidate all the reports, all the recommendations of information technology, core banking system, and that is how this committee came into existence. And as regards any benchmark, I'm sorry to say that there was no benchmark or any international report of similar nature. And I understand that when the IMF's FSAP came to Reserve Bank in 2012 or 13, they appreciated this report because it was so comprehensive, covering all aspects of information technology, information security, and much ahead of its time, as you rightly said it.
Undoubtedly. But do you see the guidelines followed in letter and spirit today?
Very, very good question. See, this report issued guidelines on April 29th, almost exactly this day in 2011. It is mandatory. It is not a recommendatory. It is a mandatory guidelines, and all banks have to implement. But RBI gave a timeline of 6 months, 1 year, and 2 years for implementing various guidelines. So most of the banks had implemented almost all the guidelines by the 2 years from 2011. And I have to say that RBI has a very comprehensive IT examination every year, especially from 2017. RBI started conducting what is known as IT examination for all the banks. It is an annual exercise, a very comprehensive exercise consisting of IT experts, cybersecurity experts, and all the banks are given a report immediately after the inspection is conducted. So I'm surprised to know that some banks have not implemented some of these guidelines.
So this raises several questions. Where exactly are banks lagging? Why have they not been able to bring their systems up to speed in the last 4 years? Are there systemic glitches? Is there not enough investment? Is it an awareness issue or a lack of understanding of its criticality right at the top levels? To get answers, I spoke to Umesh Jain, a banking tech veteran with stints at Citigroup, Yes Bank and NSC. Now an independent consultant. Here's Umesh.
One thing I must say is banks have the most complex technology architecture. The second thing is the technology changes very fast. Banks are usually the early adopters of newer technology. So from that perspective, there are a lot of compliance requirements. In terms of what are the top 3 mistakes, let me divide my response into 3 components. One is at the board level, what's happening. Second is more at the CXO level, overall organization, leadership management. And the third one is more at the IT executive level. At the board level, if you see, most of the board members have not had informal technology education in their careers. From that perspective, a lot of them are technophobic. The second thing within the board is there's a huge dependence on one subject matter expert who is a technology expert. And most of the board looks at that person in terms of guiding any discussion with technology. But again, their focus is largely technical aspects of things and not around technology management and governance. The content quality and quantity that is presented to board itself is very technical. So board is not able to relate to it. So they tend to flip over it and ask questions if there's something concerning, etc., that they should be known on. And the last important thing about the board level is, the understanding of technology risk does not really go beyond security. The second is more at the CXO level. The business heads, leaders, they all want business cases to be delivered very fast. They understand that something needs to be done so that they can make money. But they're not able to fully appreciate the risk aspect of technology. They're not able to fully appreciate the architecture aspect of technology, the governance aspect of technology, because they're driven by their own goals. And the committee that takes the decision is not fully aware of what it requires to run technology. Coming to IT level, the CIO and the team, they are not tuned to a risk culture. They like to make things move fast. And on top of it, they're not able to communicate effectively. Even if they appreciate certain processes, etc., they're not able to communicate effectively. So these are the top three challenges to me as a bank, why you see such actions happening.
Umesh told me the high cost of compliance is a big deterrent. I asked, how high are these costs?
RBI recently came out with guidelines for new banks, right? And they said 1,000 crore is the minimum equity requirement. And my estimate is, and I think I read it somewhere, that it's 250 to 300 crores of investment in technology when you start a bank. And that's how they've arrived at 1,000 crore capital. When we talk about one of the top two private banks in the country, we are talking about almost $500 million per year kind of technology spend. It varies from bank to bank, but I would say very easily, the moment you say I want a disaster recovery, which is same as production, we are talking about 2x the cost, right? So you can very well say 30-40% of the cost of the total setup is actually towards disaster recovery. And one of the things that most of us not able to appreciate, or we wonder, this is all idle capacity, right? This is just lying idling. 40% of my spend is going to something that I'm not even using. Only on a black swan event day, I'll be using that capacity. Mm-hmm. So I think that's where the challenges start building in.
Umesh, which are the banks that you would say have been ahead of the curve in building robust IT systems?
There are rarely banks I have come across in Indian context, which I would say are ahead of the curve on these aspects of things. So the banks are really ahead of the curve in terms of using technology. On the technology management and technology governance, I do not think I can name even a single bank from what I know, whom I will say is ahead of the curve. In fact, when it comes to MNCs also, I don't know many banks which are ahead of the curve. To me, the only name that comes to my mind, it might be a little biased because I worked there for 14 years. I think Citi has been ahead of the curve. So when I said Gopalakrishnan Committee Report 2011, I'm also talking about the same concepts being used in Citi in 1994 when I joined Citi. But when you start looking at the overall picture, you realize why all these processes, etc., are important. No American bank or European bank I have seen closely comes close to that.
And this is a good time for you to refer to some of your own experiences and what you did in terms of building more robust systems.
So I'll take example of NSE because it's a really study in terms of the size and the complexity. Just to give you a sense of the size, when I left NSE in 2015, we were doing 1 billion orders in 6 hours trading window. And every order is processed in 30 microseconds. 1 microsecond is 1 millionth of a second. So in 30 millionth of a second, one order is processed. They could process up to 4.5 billion orders in 6 hours. The uptime requirement, the systems have to be up 99.999% of the time. And the only way you would know the systems are down is when the CNBC ticker or whatever ticker stops flowing and regulator and finance minister are on the call. Let's say your payment system is down for 3 minutes. The markets in 3 minutes would have moved significantly. And the moment a system goes down, there is panic. So markets move much more.
Right.
Some people will make money, but some people will lose money. So it takes out trust from the market. Now, when I was hired, I was told that we are one of the best technology companies in the country. Having said that, how to run technology, how to govern technology, all these things that, for example, have been mentioned about Kotak in terms of change management, patch management, etc. These were things which were not really in place. They were not properly in place. Or if they were in place, they were more in letter than in the spirit. And over 3 years, we took chunk by chunk. We created a structure which was aligned to this structure. We created policies, processes, governance mechanisms, and a roadmap. It didn't happen overnight. We brought down the unit cost of a transaction to 1/10. Okay. We brought down the operating expense by 20%. We actually started executing projects much better. Earlier, whatever was budgeted, we were spending only 45%, more like BMC, right? We're not able to spend. And we took the capex utilization to 95%, from 45% to 95%. That means whatever we promised, we started delivering.
Understood. Okay, last question to you. A two-part question, actually, that a lot of people seem to be saying that the regulator is overstepping a little bit in its penalizing actions, which are getting stricter and stricter, sterner, if you would have it. So one is, do you think that's true? And the other is, do you see these bits and pieces of penalizing actions getting formalized into perhaps more regulatory mandates for stronger digital guardrails that banks need to put up in the future?
Let me say very clearly, I do not believe regulator is overstepping. The one-word answer is no, they're not overstepping. While I cannot comment on the quantum of penalty or the specific actions regulator is taking, but what they are demanding, what they're pointing out is extremely important and crucial. And from my own experience, again, and in Kotak's case, it has been mentioned. In Paytm's case, we know that. In HDFC case, we know that. They actually give you enough long rope, enough lead time to fix those issues. What has happened in last 1 decade, and I've been more or less out of banking directly in terms of line function, but I've seen a lot of banks as a consultant, is RBI supervision department has stepped up its capabilities. They have built capabilities both in terms of technology coverage, in terms of the width as well as the depth.
True.
So if I just take Gopalakrishnan committee report and a supervision report from 2012 or 13, RBI did not have the capability to, let's say, validate a bank against that kind of a report.
Mm-hmm.
But today, they have both the capacity and the skills to validate a bank against that report. The second aspect you have to understand is technology changes very quickly, very drastically, and every new technology brings its own challenges.
Mm-hmm.
So many a times, RBI may not have some guidelines or something, but if they find something that might be raising an alarm, they do point it out to the banks. And it might not be documented, it might be verbal. And sometimes banks tend to ignore some of those things as just an advice and not really some. Financial innovation, technology innovation, the regulations will follow the innovation. If one expects the regulations will be there on day one and then the innovation will happen, then innovation will never happen.
So you say there are enough guardrails already?
I think there are enough guardrails. When it comes to technology, again, I go back and say, that has been added over and above 2011 report, even though technology has changed drastically. See, let me put it like this. A loan is a loan is a loan. In 150, 200, 3 years of lending, loan has not changed. Similarly, the way you run technology keeps changing. But the way you run technology only grows incrementally. So I think it's a very good point that these are not changing regularly. If they were changing drastically again and again, then there will be an even bigger challenge.
And challenges will remain, with banks being early adopters of technology but lagging in its timely upgradation and upkeep of the governance standards around it, plus the massive rush in onboarding customers online. There will be some time before the intersection between Indian banking and its tech becomes smooth. That's it for today. You were listening to this episode on The Morning Brief. It was produced by Neil Ghai and Vinay Joshi, sound designed by Rajas Nayak. Do listen to The Morning Brief episodes as they drop every Tuesday to Friday on a listening platform of your choice. Do like, share and subscribe. Keep listening. Have a good week. The external clip used in this episode belongs to its owner. Credits are mentioned in the description.